VISTA, is an abbreviation for variation, inheritance, selection, time and adaptation. This is part of Darwin's theory of evolution. Post the recent changes in taxation on debt mutual funds, traditional asset allocation in financial assets needs to evolve beyond pure equity and fixed income to include multi-asset investment solutions to optimize risk-reward. In general, financial assets can be divided into core and satellite. Equity and debt form core allocations, while gold, hedge funds, private equity, venture capital, private credit, venture debt and real estate are satellite allocations. In terms of classification as per liquidity profile, equity, debt, gold and hedge funds are the most liquid assets. In contrast, private equity, venture capital, private credit, venture debt and real estate are the most illiquid asset classes. This is important to note when making allocation decisions. The key risks associated with fixed income portfolios are market risk, credit risk, and liquidity risk. Equity savings funds become an important category for fixed income allocation going forward. These funds have relatively better risk-reward characteristic versus traditional debt funds, and hence should be part of core allocation within fixed income portfolios. When you look at the distribution of 3-year rolling return on daily basis, we find the equity savings fund category has the ability to preserve capital, provide consistent inflation-adjusted returns, with ability to outperform traditional debt funds. The market expectations for the peak Fed funds rate have been revised downwards by 75 bps, after the Silicon Valley Bank event. When we look at the global GDP growth outlook, India is expected to be the fastest growing major economy in the coming year. Domestic private capex is on the rise, driven primarily by PLI. The equity market's earnings have seen healthy earnings growth for the last few years, which is expected to continue. As per the temperature gauge index, valuations are still in fair value zone. For incremental investments, we continue to suggest 50% deployment immediately, and 50% to be staggered over 3 to 6 months, while being able to accelerate deployment during sharp corrections. Based on trailing 12 months earnings, temperature gauge index suggests that large cap valuations are still in fair zone. We maintain a bias towards multi-cap and select mid and small cap strategies across MF, PMS, and AIF platforms. The RBI, in an unexpected move, chose to pause and left policy rates unchanged. Key reasons include global growth concerns, moderation seen in domestic headline inflation and real rates approaching RBI's earlier stated comfort level of above 100 bps. RBI has mentioned it would keenly monitor macro variables and has kept the window open for necessary actions in future meetings. We suggest that around 65% to 70% of the fixed income portfolio should be allocated equally to 3 to 5 year maturity high-quality GSEC or AAA, equivalent accrual debt funds and equity savings funds. To enhance the yield, 30% to 35% of the overall fixed income portfolio can be allocated to REITs, InvITs, select high-yield NCDs, and private credit strategies. For liquidity management or temporary parking, investments can be allocated to arbitrage, ultra-short-term, liquid or overnight strategies.